Good day, investors. Today we are going to look at Peyto, which is a Canadian natural gas producer. We're going to look at the meaning of the business. Do I understand what the company does, how it makes money? Does the business have any lasting advantages over competitors? Are the people running the company competent, trustworthy, and good at allocating capital? What are the incentive structures? And margin of safety, which is am I buying the stock at a price low enough that I'm protected if things don't go perfectly? So looking at this, you can see that hydrocarbons continue to dominate, representing more than 85% of global energy consumption, despite decades of, let's say, diversification into green areas. Natural gas shows strong growth with a compounded annual growth rate of 2.2% since 2000, and now makes up over 25% of global energy use. Coal and oil remain large contributors, but natural gas is increasingly preferred for reliability and lower emissions. Reliability is key. The sun doesn't shine always, and the wind doesn't blow always. Of course, renewables are growing, but from a far smaller base and slower, and still represent only a minor share of global total energy demand. You can see renewables just here. Global GDP and energy consumption rise together, of course, showing that economic growth remains tightly linked to rising energy use, which is not a surprise to anyone. Projections suggest that energy demand will continue increasing. IEA, the International Energy Agency, recently said oil demand will grow till 2050. Of course, who cares what they say? They've been wrong the last 20 years, probably because they have a political agenda, but even they have to cave, like BP and others. So even with efficiency improvements, growing renewable adoption, you will need more energy going forward. So that's the underlying thesis what Peyto is presenting to us. These are from their corporate presentations. Okay, so look at them in more detail. So North America is in a major LNG growth phase, with export capacity forecast is to rise 31% in 25, the largest jump since 2019. Multiple US Gulf Coast and Canadian West Coast LNG projects are advancing toward first gas or expansion, increasing export optionality across the continent. This is key. So you see all these, you can pause the video, you can see all these LNG spots growing, right? So this capacity build out will lift North American natural gas demand by more than 5 BCF per day, supporting sustained production growth. LNG export infrastructure is expected to continue through 2029, effectively doubling total export capacity by the decade's end. And then you can see the breakdown here. Both the US and Canada contribute meaningfully with these additions, and you can see Mexico adds smaller but strategic incremental capacity. This is key because, let's say you're in Canada, you have your local gas price at $1.4. In the US, you can sell it for 5, in Asia or Europe, maybe 10. So that's your business case right there. You just have to get your stuff out. Okay, looking at Peyto, you see their market cap. This is Canadian dollars, right? So just below 5 billion. They have a PE of below 13, and then they have a nice dividend yield of 5.7. Peyto's share price is strongly up year to date, as you can see here, reflecting market confidence in growth, diversification, and future cash flow potential. Of course, the underlying commodity, one of the underlying, right, we will see about their gas price differentiation is down, via the Henry Hub is up huge, so right, this is different, right? Henry Hub prices remain above 5, while AECO is low, a clear example why accessing multiple markets improve revenue stability. So stock continues to perform well. As North American and global gas markets diverge, selling Western Canadian gas beyond AECO, including Europe, US, and Asia, becomes increasingly valuable. Strong dividends, as you can see, close to 6%, disciplined valuation metrics, low PE, and reduced cyclicality because of the diversification of gas prices support the investment case as Peyto expands market reach. Okay, so this is more about their price diversification. Peyto significantly reduces pricing risk by diversifying sales across hubs rather than relying solely on the AECO. You can see it here. So fixed price contracts in gray, and physical transportation agreements provide stable, predictable cash flow through the years. So that's, you have something fixed at least, right? Only a small portion of reserves are tied to fixed prices, giving Peyto flexibility to benefit from future market strength. Diversified exposure to US and Eastern Canadian helps strengthen overall realized pricing and reduces volatility. You can pause the video and look at all of these, where these are located, how they are diversifying themselves. So that's great. And then regarding their reserves, Peyto maintains a strong long-term reserves of assets. So PNP means proved plus probable, and supporting a more like 28 years of PNP. If you just do what they do, like reserves divided by annualized production of Q4, this is great. This is huge. And then this is the less more conservative number, but let's just take proof plus probable. This is really good. A healthy reserve base ensures long-term production capability and underpins Peyto's ongoing growth strategy with your unlocking of Canadian gas and rise of gas prices and use. Pretty good. Okay, so looking at this, Peyto maintains the lowest cash cost among its peer group, creating a durable competitive advantage as much as you can get, right? Because you're still reliant on the commodity you're selling. And then on the bottom, I included from their presentation who are the peers they're looking at. So gas-weighted peers and oil-weighted peers, right? Okay, so because costs, as they say, are sticky, Peyto's disciplined cost structure directly translates into stronger and more resilient margins in theory. Even as predominantly gas-weighted producer, Peyto delivered higher after-tax margins than many liquids-weighted peers in 24. So you can see it here. And then you would say like, hey, aren't they just selling gas? They don't produce crude oil. What they have is NGLs, so natural gas liquids, right? Which is you get while you also get natural gas, right? So, but look at this percent of liquid, they are pretty low, and then after tax margins as they calculated, right? Maybe we should double check all of these numbers. That's a really good point. Actually, you always have to check all corporate presentation numbers. That's why I have my own Excel sheets. Just never trust anything. But looking at this, they're doing pretty good, despite not having oil, which currently is selling at a higher BTU, British Thermal Unit base. So you can get pretty good margins there. So this margin outperformance shows how cost leadership and efficient operations can outperform commodity mix. So low-cost operations position Peyto to generate strong returns across all gas price environments. And luckily, we are looking at gas prices going higher. Okay, so Peyto consistently lifts realized gas prices above AECO through diversification and hedging, adding meaningful value each quarter as they show it. So you have your AECO price here, and then you have diversification in blue, and then you have hedging, and then you have the mix of the two. So it varies. Maybe we should research later how their hedging works, but this looks good. So diversification premiums and hedge gains provide a stable uplift overall, allowing Peyto to outperform local market pricing even when VAECO is weak. So you can look at this 357 in total in Q3 when VAECO was half previous year. So they are doing pretty good on the financial side, fixing their prices. So realized prices remain stronger and more predictable, supporting cash flow stability and planning visibility. Another point is that royalties have declined through 24 into 25, falling as a percentage of sales, which further improves netbacks and profitability. Lower royalty burdens combined with enhanced price realization strengthen their margin resilience in a volatile gas market. This is pretty good tendency to just get royalties out basically of your business. Okay. So we're gonna look at free cash flow and dividend since 2018. So Peyto's strategy is basically is built around generating strong, sustainable free cash flow, even through volatile gas prices in theory. Free cash flow has rebounded significantly since 2020, you know, when prices really crashed, driven by higher production, right? Disciplined capital spending and improved price realization. The company targets a balanced and disciplined payout, ensuring that dividends remain fully funded by free cash flow and not by debt as some companies did. I think I did a video on I think it was Nestle, and they have an insane strategy, if you can even call that. they were borrowing a lot of money and just buying back shares. If you are interested, check that out. It's really funny. They have insane amount of debt and just bought back a lot of shares, drew share price up, and then now they are left with a lot of debt. But that's another story. So their payout framework prioritizes balance sheet should be fine. So if you look at the MDA, so the discussion material, which highlights that Peyto's approach is to maximize shareholder return, of course, and while maintaining financial flexibility and long-term resilience. So this is good. Let's look at okay, this I want to look at more. All right, so you see shares outstanding, production, debt to equity, right? So first, let's look at share dilution from 165 basically to 202. That's 22.5 dilution. Okay, so that's the new shares they issued. What did they get for it? Well, they got production. So from 92 to 132 basically. This is a 43%, 43.2% increase in production. And reserves, I don't have reserves on this chart, but reserves grew from 803 million to 1370, so a 70% reserve increase, which also means that their basically total reserves divided by production increased from 24 years to 28 years. Debt to equity dropped from 68 to 45, which is also great. Some other credit metrics I don't have on this chart is their coverage ratio in Q3 25 was 8.4 times. So their EBIT covered their interest payment more than 8 times. Between 2018 and 2024, that averaged 5.3 times. So technically a Q3, maybe there are some seasonality, are better than their average, although 24 was also 5.3. And their cost of debt in 24 was 5.7, in 25 4.2. So they're improved. Okay, their global interest rates are starting to come down, so their cost of debt will go down. Of course, their debt also went down, so it's a good outlook for their debt and debt profile. And they issued this much more shares to get this much more reserves and this much more production. So you got a lot for your newly issued shares. All right, this is where I have a little bit of a, let's say not an issue, but let's look at it. So Peyto's compensation structure places high percentage at risk. This is the CEO pay at risk, aligning executive incentives with long-term shareholder value in theory. So leadership is required also to maintain significant equity ownership, reinforcing commitment to performance and capital allocation. You have the CEO 26 times multiply. Yeah. So they have good skin in the game in theory. By the and here is my issue with this, is that the company does not fully disclose their KPI weighting scorecard. So the MDA, so I don't see a clear scorecard like this is how I pay my CEO. I want to get these KPIs. What I get is that basically in their MDAs they highlight the metrics are nice. Let's put it that way. So they have funds from operations, free funds, right? So that's financial strength, net debt, leverage. It's good. Capital balance sheet approach, production volumes and operational costs, great, and realized prices and hedging performances. So these are business metrics. I would like to have a scorecard and not just a guess. Okay, and then if you look at on their information circular, when I get this and this, you also get this. So you can see their Peyto's performance relative to major indices shows strong value creation, validating alignment between compensation instead. So technically, they're doing okay because we outperformed everything else. That's the theory. I guess this is also included in their valuation metric, like total shareholder return. They have a total shareholder return policy. So this is, but I would still like to see a more clear incentive structure. All right, so looking at outlook, Peyto's 26 capital program is aiming at 450 to 500 million, which supports disciplined growth. Management targets 5 to 10% a year growth. Now I have to say that between 2018 and 2025 Q3, their growth was 4.5% compounded annually, right? So when I'm gonna look at my own models, I'm gonna use 5% and not 10. So I'm just gonna pick the bottom of the barrel. Okay. They also, which is interesting, is we are here. So they are expecting AECO prices to go higher. So catching up, maybe with Henry Hub. So that's interesting. So this strategy kind of balances moderate growth, moderate to high growth, I would say, actually, with a strong financial discipline, positioning the company well for a rising gas price, which they expect. All right, so now to the good part. On this chart from their presentation, you can see that they highlight that 20-year average return on equity, 24%, and return on capital employed, 14%. I would like to say that you can see this chart. This is volatile as hell. This is your realized price. So you have these returns when prices are up. So that your moat is still really exposed to natural gas prices. You get this average because in the 2000s you get a lot of return equity coming out. But if you look at my numbers that I calculate from free cash flow down below, you can see that since 2018 the average was 8.5, and then Q3 annualized is basically 10%, and return on investment is also lower. So this period, so basically this is what I looked at, is much lower than their long run average. So maybe it's a good time to buy, but it's the companies was much different in this first period. The theory was much different than now the theory, and we are in a good theory. The investment theory behind this is really stable. Maybe we can return to higher returns, probably. Debt we discussed. Okay, so they are really sensitive to natural gas prices, right? With LNG growth, Henry Hub fundamentals, macro tailwind, this all appears to be positive. So probably we're gonna see this go up. Right, so okay, going to the discounted free cash flow projections, using Peyto's guidance of 450 to 500 million capex, I'm gonna use the average of that, and an annual 5% growth rate as discussed. 2018 to 2024, they grew 4.5%. They are saying we're gonna do 5 to 10 going forward. Let's use 5. Let's just be more conservative. So these production numbers are just using every year here extra 5% growth. Okay, and I use a discount rate of 10%. So my valuation comes to be around 26.6 per share. And if you look at 10 cap of 25 Q3 year to date annualized number, it's 19. Of course, this doesn't include any growth in the future. This is just a 10% return of free cash flow yield at current levels. So of course this is our value 26.6, and then it's higher than our current market price despite the 35%, 36% year-to-date rise. So we have a margin of safety. Even under conservative assumptions, moderate growth, cautious Henry Hub pricing. So if you look at my Henry Hub pricing here, we are already at 5.2 now. But of course there are seasonality in Henry Hub. So even cautious Henry Hub pricing, moderate growth, and a relatively high discount rate of 10%, the shares still offer a clear margin of safety around 15%. So the investment case ultimately hinges on a simple point. If gas improves, gas prices. So Peyto's return can re-rate significantly, and current pricing does not fully reflect that upside. If I used everything really conservatively, if they do just baseline or better, you can have a much higher intrinsic value than this. All right, to summarize up this video, let's look at how Peyto looks. Meaning green. So Peyto is a Canadian natural gas producer benefiting from a major macro tailwind as global LNG demand grows. Canada's gas can now access higher price markets. Let's say you sell something locally for $1 and that becomes 5 in the US, 10 in Europe and Asia. So unlocking value for a value far above local pricing. On their moat, Peyto is a price taker, right? But its low-cost structure gives it a durable advantage over local peers. Through market diversification, Peyto can sell internationally at much higher prices, strengthening future margins as global demand rises. And 3, management. So KPI disclosure is not perfect. I don't see clear scorecards, but management consistently highlights core value drivers like FFO, so free funds of operation, free cash flow, leverage, cost, realized prices, right? So this is key. Their long-term performance and capital discipline show management is competent and aligned with the shareholder. They have some skin in the game as well. So this yellow is just that I want to see a scorecard, otherwise it would be a clear green. And then a margin of safety, even with the conservative assumptions, 10% discount rate, 5% growth instead of 10, and moderate gas prices outlook, Peyto still has a 15% margin of safety. As recently Recruel put it, it's cheap enough. And looking at all the stocks we researched so far, you have Peyto here with the 15% margin of safety. I would say this, if I just use 10% growth, this could be like 30 something, so it would be higher up here. This is a buy as of now. Of course, it's not a financial advice. You should look at your own situation. I'm considering this. This is interesting. And of course, you've heard Rick Rule in recent interviews over the past month saying that he sold his gold, some of his gold, 25% of the gold portfolio, and bought a lot of oil and gas. So that's a good direction. I'm going to look at a couple more Canadian stocks, and then I'm thinking to looking at, I have also a list, you guys sent me questions and comments to look at. I have a list of companies, but I'm really wanting to look at probably coal next, but we'll see. Okay. If you enjoyed this video, please like and subscribe. Let me know down in the comments what companies you want me to look at, and see you next time. Take care, guys. See ya. Cheers.